Okay, let's try a little thought experiment. Picture yourself leading a growing company, say, back in the 1990s. Things are going well, you've got ambition, and you're thinking, right, time to go global, need some overseas funding, maybe list somewhere like Hong Kong. Sounds, well, almost routine today, doesn't it? Something you could practically arrange online. But let's actually rewind. Go back to the 90s. Suddenly, that plan, uh, not so easy. If you were a Chinese enterprise back then, trying to tap into foreign financing was, well, it was incredibly tough. Borderline impossible, some might have said. So today, we're diving deep into that period. We're going to explore the really fascinating, ingenious ways Chinese companies figured out how to connect with global markets. We're talking about the story of red chips. It's a story packed with, honestly, some pretty surprising twists and some seriously clever financial footwork that bridged what looks like an unbridgeable gap. So to really get our heads around how they pulled this off, let's start with the basics. What exactly is a red chip?
Yeah, good starting point. Because the name itself tells part of the story. Red chip, that term popped up in Hong Kong back in the 90s. Mainland China was often casually called Red China then. So red chip became the nickname for companies that had significant backing or funding from mainland China, but were actually registered in Hong Kong.
Ah, okay. Like who? Any early examples come to mind?
Oh, definitely. Think about CITIC or Everbright. Those were kind of the classic early red chip companies, mainland roots, Hong Kong address.
Okay, so it started with those big state-connected players. Did the definition sort of stretch over time? Did it end up including, say, the kind of tech companies we might think of now?
It absolutely did. It broadened out quite a bit. What started as, a label for those specific Hong Kong-registered mainland-funded firms, it eventually grew to cover pretty much any business with strong mainland ties that listed outside the mainland itself. So yeah, fast forward, and you look at giants like Sino or Tencent, they fit into that wider red chip enterprise umbrella too. Shows how the term adapted, really.
No, that's really interesting. So when we talk about red chips, are we talking about this broad category, or is there like a more specific financial setup involved too?
That's a really key distinction to make. You can talk about the overall red chip structure, which is that big picture institutional design, mainland business, overseas registration, overseas listing. That's the wide lens. But if you zoom in, red chip stocks often specifically refers to a particular model. It was the one used mainly by state-owned enterprises designed precisely to connect their assets back home with funding available overseas. It's a specific tool within that broader concept.
Right. And this really underlines just how crucial Hong Kong was in all of this, doesn't it? Almost like a necessary bridge. And underneath it all, this constant hum of financial innovation. Okay, so to really get why these red chips were so clever, we need that historical backdrop. Let's go back again, maybe to the 80s. Chinese companies were pretty isolated, right? And the government knew it needed foreign investment, foreign tech.
Exactly. They were trying hard to open up, attract that capital. But how? The first sort of attempt involved creating what they called window companies.
Window companies.
Yeah, basically enterprises set up by the Chinese government or even provinces directly in Hong Kong. They were meant to be a sort of opening of a small window onto the global stage. You had CIIC, which Rong Yuran started at Deng Xiaoping's urging. You had Everbright, China Resources, central government initiatives. Even provinces set up their own. And the key thing was, these weren't just mainland offices. They were incorporated in Hong Kong. Local Hong Kong companies, legally speaking, but obviously with very strong mainland backing.
And Hong Kong already had the sophisticated financial market way ahead of the mainland at that point. So these window companies, they started playing the market.
They did. They started looking at capital operations pretty quickly. And their first move, and this is where it gets really interesting, was something called backdoor listing.
Backdoor listing, okay, unpack that for us.
Sure. So instead of going through the whole complicated process of listing directly, which was tough, these Chinese-funded window companies would find a small existing company in Hong Kong that was already listed on the stock exchange. They'd then acquire it, buy it out, and just like that, boom, they controlled a publicly listed entity. It was a shortcut, a workaround.
Any examples of who did this?
Oh, yeah. CITIC bought a company called Sun King Feng. The Ministry of Aerospace Industry got Kangley Investment. China Resources took over Yongdali. It became a common playbook. You ended up with this structure that some people described as having a capitalist shell, the Hong Kong listed company, but with a socialist core, the mainland entity and assets behind it.
Huh. But how did the Hong Kong market react initially? Were they immediately impressed by these newcomers?
Well, not exactly. There was actually a bit of maybe skepticism or even mockery. These early red chips were often pretty small, not super active in trading. I remember hearing that some senior investment bankers back then used to kind of jokingly call them mainland uncles.
Hmm.
It wasn't exactly a term of endearment. They weren't seen as major players yet.
Mainland uncles. Okay. So despite this backdoor strategy, they weren't really setting the market on fire. Was there a moment when that changed, a specific company or event?
Oh, absolutely. There was a definite turning point, and it came, perhaps surprisingly, from Shanghai, a company called Shanghai Industrial. They executed a listing that just completely changed the game and blew that mainland uncle image out of the water.
Shanghai Industrial. Okay, what was going on in Shanghai then that made them need to do something so dramatic?
All right, so Shanghai in the 90s had this unique situation. People called it one abundance, one shortage. The abundance was opportunity. Pudong was developing rapidly, huge economic growth, tons of projects needing investment. But the shortage? Funds. Capital. Shanghai just didn't have enough money locally to fuel all that growth. So Shanghai Industrial, being the city's window company in Hong Kong, got a massive mission. Go out and bring back foreign investment. Lots of it.
Okay, big pressure. And who did they put in charge of this mission?
In 1995, they brought in a new chairman, Kai Lacing, known for being quite open-minded. And he did something really smart. He hired this incredibly young, really sharp team focused purely on capital operations, recruited from Shenyang and Wangwu Securities. We're talking people like Lu Mingfeng, Zhu Ji, Yao Feng, names that became, pretty legendary later in the Shanghai, Hong Kong finance world. It wasn't just hiring bankers, it was bringing in a whole new way of thinking.
And this new team, faced with the funding shortage you mentioned, they couldn't just do the usual backdoor listing.
Exactly. That was the problem. As a city-level window company, Shanghai Industrial just didn't have the kind of cash needed to buy an existing listed company in Hong Kong. Backdoor listings weren't cheap, so they had to innovate. And they came up with two massive innovations. First, instead of backdoor listing, they pioneered shell creation for listing, building their own door, essentially. Yeah. And second, they figured out a breakthrough way to actually operate domestic assets within the overseas capital market framework.
Shell creation. Okay, how on earth did they create a shell without buying one? What was the magic trick there? What was this Shanghai consumption idea?
Right, this was the genius part. The team realized, okay, we can't buy a shell, so let's build one. They worked with the Shanghai municipal government to acquire some older, maybe somewhat underperforming state-owned assets. Think Shanghai Jiahua, the cosmetics company, or Sanwei Pharmaceutical. Then they did the really hard work of restructuring these companies, cleaning up their accounts, clarifying property rights, making sure everything met the strict rules of the Hong Kong Stock Exchange. This was crucial. Once these assets were polished up, they injected them into Shanghai Industrial, the window company. So Shanghai Industrial became the listed holding shell, purpose-built in Hong Kong to hold these Shanghai assets and raise money. It was less about buying assets and more about packaging them appealingly.
And the Shanghai consumption angle was key to that packaging.
Precisely. They framed it as offering investors a piece of the booming Shanghai consumer market and infrastructure growth.
Wow, okay. And why did that model click so well with international investors? What was the appeal?
It was like the perfect formula for them at the time. On one hand, you had the comfort factor. It was a Hong Kong company operating under familiar rules, which international investors trusted more than dealing directly with mainland entities back then. But on the other hand, it gave them direct exposure to China's incredible growth story, which everyone wanted a piece of. It basically removed a lot of the friction, the regulatory hurdles, the trust issues that came with direct mainland investment. It just felt safer and easier, but still offered that massive upside.
And the market reaction, was it as good as they hoped?
Oh, it was unbelievable. Way beyond hopes, probably. When Shanghai Industrial finally listed, the shares were oversubscribed 158 times. Just imagine the demand.
158 times, that's staggering.
It really was. And naturally, the stock price shot up on day one. Its trading volume, just for Shanghai Industrial, accounted for nearly 10% of the entire Hong Kong stock market's turnover that day. One single stock.
Incredible. And did they capitalize on that momentum?
They absolutely did. Shanghai Industrial Holdings, as it was known, didn't just sit back. They went on an acquisition spree, using their new capital and market credibility. They started bringing in more iconic Shanghai businesses, the Oriental Shopping Mall, Lianhua Supermarket, Bright Dairy, even assets related to the city's elevated roads, key consumption plays, key infrastructure. And get this, in just 1 year, this company that nobody really knew before raised over 10 billion Hong Kong dollars for Shanghai.
10 billion HKD in a year.
Yeah. And just for context, back in 1996, that $10 billion was more than the total amount raised by all the companies listed on Shanghai's own A-share market that whole year.
Wow. So they literally created a vehicle that turned the Shanghai story into hard cash for building the city. That must really open some eyes back in Shanghai.
It absolutely did. It made the municipal government truly grasp the sheer power of the capital markets in a way they hadn't before. This wasn't just talk, it was tangible money-funding development. And Shanghai Industrial wasn't just a flash in the pan. Its performance was so strong that by early 1997, it was added to the Hang Seng Index. It became a blue-chip stock. Still is, actually.
Amazing.
And that success story didn't go unnoticed. Beijing, Tianjin, other major cities started looking at this model. Hey, Shanghai did it. Maybe we can too. And that really kicked off what people call the red chip whirlwind. From about 96 to 2000, it was the moment Chinese-backed red chips stopped being mainland uncles and started becoming serious blue-chip players in Hong Kong.
Right. Now, you mentioned H shares earlier. This might be where people listening get a bit confused because H shares are also Chinese companies listing overseas, right? So what's the actual difference between a red chip like Shanghai Industrial and an H share?
Yeah, it's a really common question, and the distinction, while maybe sounding a bit technical, is super important. H shares are domestic Chinese companies registered in the mainland that list directly on an overseas exchange like Hong Kong. The company itself is mainland-based. Red chips, like we saw with Shanghai Industrial, involve taking domestic Chinese businesses or assets and injecting them into an overseas company, typically one registered in Hong Kong. It's that overseas company holding the mainland assets that then gets listed.
Okay, so the listed entity for a red chip is actually a Hong Kong company, not a mainland one.
Exactly.
And did that structural difference matter in practice, especially back then?
Oh, hugely. For starters, back in those days, many H shares weren't fully tradable. Large chunks of their shares were held domestically and couldn't be bought or sold freely by international investors. That hurt their liquidity, made them less attractive. Red chips, being listed as Hong Kong companies, could usually have their shares fully circulated, much more appealing for global investors.
Okay, so better trading liquidity. Any other advantages?
Yeah, regulation was another big one. H shares, being mainland companies, had to navigate a much more complex web of approvals and oversight from different government bodies back in China. The red chip structure, with its overseas shell, just found it easier to align with how overseas markets worked management styles, capital operations. It tended to be a smoother process, less regulatory complexity compared to direct H-share listings at the time.
Got it. So that structure really offered some concrete benefits. And are there well-known companies today that still follow this red chip model?
Definitely. It's an enduring structure. If you look at the Hong Kong market now, many big names are technically red chips. Think about CITIC Pacific, China Resources Land, Bank of China, Hong Kong, even Lenovo Group. These are all essentially Hong Kong registered corporate shells that hold significant mainland businesses and assets listed in Hong Kong. The legacy continues.
But thinking back to Shanghai Industrial, its impact wasn't just about raising money or listing companies, was it? You mentioned it changed things within Shanghai itself.
That's right. And this might be one of the most profound, maybe less obvious impacts. It fundamentally helped to change the mindset around state-owned assets in Shanghai, concepts like joint stock ownership, using capital markets actively. These weren't exactly second nature in the traditional state-owned sector, especially in a city like Shanghai with such a strong history of state control. It was hard to just shift that internally. But Shanghai Industrial, with its model of an external shell driving internal change, used the power and discipline of the international capital market to push these modern ideas through. It forced a kind of modern transformation, a baptism by capital, for many of those old state enterprises.
So it wasn't just money, it was also importing modern corporate governance ideas.
Exactly. It helped embed those ideas of clear property rights, shareholder value, active capital management. That kind of software upgrade for the city's economy, you could argue, was even more valuable in the long run than the billions raised. And tied to that, there's another legacy. Think about the people involved. That young team Kai Lake-Sing brought in, and the people who came up through the Shanghai industrial system over the years. That group has become this incredibly valuable pool of talent. They're still some of the most influential figures operating between the Shanghai and Hong Kong capital markets today. That human capital, that expertise built up, that's a huge intangible asset, maybe the most important one.
What a fascinating story. It really is an incredible journey from the 90s when getting foreign capital seemed almost impossible for Chinese firms to the emergence of these red chips completely reshaping that connection to global finance. Just pure ingenuity, really.
It really is. And it makes you think, doesn't it? Seeing how they navigated those huge barriers back then using creative financial structures,
Hmm.
it makes you wonder what other sectors or maybe even other economies today that feel sort of stuck could potentially benefit from similar kinds of innovative thinking, finding new ways to connect local potential with global capital.
That's a great point to ponder. So, as you've been listening to this deep dive into the world of red chips, what's the one thing that really stood out to you?
We genuinely love to hear your thoughts on this. Jump into the comments section and let us know what resonated. On.
Yeah, let us know.
And hey, if you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.